Welcome to Tesla Deep Dives.
The topic today, the FSD Transfer Sunset, weaponizing software value and rewriting the economics of Tesla vehicle ownership.
Welcome to the deep dive on the FSD Transfer Sunset, a policy shift by Tesla that is quietly rewriting the economics of vehicle ownership and weaponizing the value of its software stack. For years, the full self-driving package, priced up to $15,000, has been a contentious, non-transferable investment tied to the car's VIN. Tesla's recent move to make the transfer amnesty permanent, then abruptly end it, while simultaneously eliminating the lump sum purchase, signals a hard pivot toward a pure recurring revenue model. This isn't just a marketing tactic, it's a strategic ultimatum to the loyal customer base, designed to lock in future high-margin income.
To understand the current sunset, we must first recognize the pattern. Since Q3 2023, Tesla has repeatedly used the FSD transfer option as a potent, limited-time demand lever to boost end-of-quarter delivery numbers, despite CEO Elon Musk initially calling it a one-time amnesty. This cycle of renewal and retraction, bringing back the offer multiple times, has now culminated in two decisive, reported policy changes: the hard sunset of the FSD transfer program on March 31, 2026, and the elimination of the one-time $12,000, or $8,000 in 2024, according to some reports, purchase option after February 14, 2026. The core financial friction point lies in the policy's impact on trade-ins. When an owner opts to trade in their FSD-equipped vehicle for a new Tesla, the $15,000 software investment effectively vanishes from the car's residual value if they choose to transfer the license. Tesla explicitly values the trade-in vehicle as though it has basic autopilot, removing the residual value of FSD because the license is transferred. This has reportedly resulted in reductions in the trade-in offer, owners claiming a loss of approximately $4,000 in valuation when opting for the transfer. This creates a financial loyalty trap. The most valuable customers, the early adopters who paid the high upfront cost and are now ready to upgrade, are forced into an unfavorable trade-off. Either they accept the significantly reduced trade-in value on their old car to keep FSD, or they leave their FSD investment with the old car to maximize its sale price, only to repurchase or subscribe to FSD on the new one. As Musk himself acknowledged in 2021, FSD should be viewed as reasonably valuable when doing a trade-in. Yet the corporate policy does the opposite, forcing the user to pay for loyalty through depreciation. From a Wall Street perspective, the shift to a subscription-only model, now priced at $99 per month, is a strategic masterstroke to strengthen the business model. Analysts see this as a way to lower the barrier to entry, potentially increasing the take rate across the fleet and simplifying the autonomy narrative. This move fundamentally repositions FSD from an unpredictable one-off capital expenditure item to a high-margin, predictable monthly recurring revenue (MRR) stream, boosting the crucial ARPU metric, average revenue per user, for the software division. However, not all analysts are bullish. A contrarian narrative, notably summarized by GLJ Research, suggests the forced switch to subscription is an implicit acknowledgement that FSD is not a valuable, complete asset, and therefore a lump sum purchase is no longer tenable. This view predicts a devaluation of FSD's contribution to Tesla's enterprise value, arguing the company is effectively admitting that the software cannot yet command its premium price point in the open market and must be subsidized by recurring payments. On social platforms and owner forums, the reaction is mixed, but frustration dominates. While the one-time transfer window was seen as an incentive, the hard sunset is viewed as a breach of trust, particularly by the early adopters who subsidized the software's development. This sentiment of being locked in or penalized for upgrading generates significant customer friction, which poses a short-term headwind against the demand pull generated by the transfer offer itself. The dominant market sentiment, nonetheless, favors the financial engineering of the move. For sophisticated investors, the predictability and high-margin nature of a locked-in subscription base outweigh the risk of short-term customer frustration. Tesla is successfully executing a pivot, moving its valuation from that of a capital-intensive manufacturer with a software component to that of a high-growth SaaS platform with an embedded hardware component. This ultimately justifies the higher multiple investors grant the stock.
Our prediction is that the FSD subscription ARPU will see a significant uplift in the quarters following the final sunset in 2026. As the large base of legacy FSD owners are forced onto the $99 per month plan to maintain the feature on their new vehicle, the recurring revenue will accelerate. Furthermore, we predict a clear and permanent bifurcation in the used Tesla market. Non-FSD cars will stabilize their residual value, while used FSD-equipped cars will suffer a proportionally larger loss of value, as FSD becomes a de facto rental feature that adds almost no residual capital value to the hardware. Between vehicles with a permanent purchased FSD license, pre-sunset, versus those with a newly purchased FSD subscription, post-sunset, which will be the clearest measure of how drastically Tesla has managed to rewrite the economics of vehicle ownership? Let me know what's your thoughts and leave your comments. Thank you for joining us for this deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.